In today's video, we'd like to talk about European inflation as well as comments from Chair Powell. Yesterday, we got the latest update from European inflation, where we can look at both trends for headline inflation and also core inflation. So what those trends are showing us is that headline inflation has marginally ticked down to 2.5% from 2.6%, whereas we're still continuing to see stickiness within core inflation, which is running at 2.9%. Now, we know from previous videos and similar trends in other regions that we've seen large differences emerging between goods inflation and core services inflation. So that's why we're seeing the difference between headline inflation and core inflation. It's that services part of inflation is driving core inflation to remain higher and stickier, as we've said, like we've seen in other regions like the UK and the US. But looking at what that will do for interest rate markets, well, we're still continuing to see that that data is moving in a positive direction, and it's more likely that Europe sees an interest rate cut in the summer rather than a region like the US. And we also know that the ECB has already delivered one interest rate cut already this cycle. Now, moving over to what we saw in the US from Fed Chair Powell's comments, he was also talking about similar things that we've seen in Europe in terms of inflation and also the labour market. Now, they've commented that they're continuing to see the theme of disinflation come through, which they've seen overall as being a positive. However, they've cautioned that they don't want to cut interest rates too soon and risk inflation moving higher off the back of lower interest rates. They've also forecasted that they don't expect inflation to move down to their target of 2% until late 2025 at the earliest. So once again, reinforcing why they don't want to cut interest rates too early, which might restart an inflation cycle. They also commented that they're keeping a keen eye on what developments occur within the labour market, as they've linked wage inflation as being one of the key components to why price inflation in things like services has remained so elevated and sticky. So keeping an eye on labour markets to see if we see weakness there, that might cause weakness within wages and ultimately cause price inflation to fall and come back towards target. So thank you for watching today's video. We'll catch you in tomorrow's episode. And if you could also like and subscribe to the channel, we can keep you updated with more videos.